That is the additional institute responsibility that you get. But my role will be always as a faculty, and that's the job that I do, right? Am I audible?
Little bit.
Yeah,
It is.
yeah, Professor Soumya, but a bit more would be better.
Okay. I'll try to raise the voice a little bit, but it's a little bit health. Voice I'm down, so might be that is affecting my voice.
We wish you a speedy recovery, sir.
Maybe there any resonance in area, or I don't know how it is.
Okay, so I think Dr. Mahesh must have taken some early sessions with you to clarify some of the basics, fundamentals. So we will build on that, and you must have received also the materials also, right? And I have gone through your profiles, so pretty interesting, the rich experience that the batch is having. And feel free to ask questions, and I will prefer and request that whoever so wants to ask question, please raise your hand, and accordingly I will take up the question. Okay. Some questions. So what will happen if I'm speaking something? I will take a pause when the appropriate time is there, and then I will take up your question. So that is one. Second thing is that at some point in time, I may not directly answer your question at that point in time, but I will take up your question at a later stage when it will be more convenient to answer, given the context that we are discussing, so that it will be very impactful for the understanding purpose, right? So that is two things that I will request you to maintain, so that learning will be effective for everybody. Okay. And one more thing, some of you might have a prior experience of dealing in the financial affairs, while others may not have. Okay. So one of participant question might sound very basic to you. Okay. Whereas your knowledge is much higher than that. But as a team, we have to also respect that question of the participant as well. And while answering, it will be my responsibility to make the answer in such a way so that it will be a value addition for you as well. Although you might be comfortable with that concept slightly early. You getting my point? So be respectful to the question of others, although it might sometimes sound very basic or something like that. That will be my responsibility to address it. But as a team, we will be respectful to the others. And if you have some prior experience of dealing in the financial matters which you want to raise, feel free to also raise. And as I said, at the appropriate time, I will take up that question in detail. Is it okay?
Okay.
Okay.
So I think everybody joined. We'll wait for 1 minute and then we will start. Dr. Mahesh, are you there?
Yes, sir. He's just joining. He's joining. Yes, sir. Morning, sir.
Okay, ma'am.
Morning, sir.
Morning, sir.
कैसे हैं sir? All okay?
Yes, sir. All okay.
Health is better?
Health is still not completely okay, but yeah.
Acha, okay. Morning, guys. Okay, all fine.
Dr. Mahesh.
Good morning, Mahesh sir.
Good morning, all.
Good morning, all.
Good morning. Good morning.
Good morning, my sir. Morning, good morning, sir.
Sir, what time you will break, sir? Break का बता दिया आपने sir?
अब सर पूरा वो टाइमिंग सीक्वेंस जो है प्लीज क्लैरिफाई टू ऑल सो दैट
Done.
at your service the way you will say the class will progress. Yes.
No, whatever it is, except for the prayer break. Prayer break, I think, where's Afros? Afros, you have given Afros ji?
He is not there.
Afros is there. Afros is there.
Yeah, he's here. He's here.
Ah, yes.
So prayer break, Afros ji, just inform the professor 5-10 minutes before. That's it.
You're supposed to log in by 11, right?
Yeah, 11. So 11 becomes what time we're talking about India time?
12:30.
1:30.
1?
12:30.
No.
12:30. 12:30.
12:30 India time is what you're saying.
Yes.
12:30 India time. Okay.
It is already 12:30 here.
12:30 India time कैसा होगा सर आपका?
Yes, अभी तो 12:30 हो गया ना. India time 12:30 है.
11 means
अभी
12:30.
12:30
Yes.
अभी 12:30 है. प्रेयर का बोल रहा हूँ. प्रेयर का टाइम.
Sorry. Sir, 1 o'clock Oman time.
1 o'clock. Okay, approximately 2:30 India time. That's the prayer time
Yes.
for 1 hour.
Yes.
Apart from that, Soumya ji, all anytime whenever you want to break at your convenience. Whatever.
Okay.
I think we can start, Soumya sir. We can start here. All the best, guys. Thank you.
Thank you so much, sir. Thank you.
So, in our discussion, I will take you to my writing pad where I will be doing all the writings regarding the class discussion. And after the class, I will share that also. I think recordings will be also made available to you. Okay. And that will be the mode of practice to follow. And as an example, we will take up Hindustan Unilever as a case study, as a sample to look at the figures, to understand the logic that we are developing and then trying to match it with the real world scenario that how things are happening in a real time company case. Okay. So for our discussion, the Hindustan Unilever will be the case study sample as a kind of company. But if you, it is not only that HUL can be discussed, any company can be discussed, logic will remain the same. And if you want to specific some company, you might keep the report in the next class and you can ask me. So that will be our. So first of all, I will go to the. Okay, so my screen is visible.
Yes, visible.
So this will be our main playing field, and wherever it will be appropriate, I will go to Excel also to show the calculations and all. But this will be our main playing field for the discussion purpose and all, right? So as we understand this accounting domain, right? Let's start with from very fundamentals, very basics, and then we will build up on that. And you have a case study also shared with you, right? Any
Yes,
case
sir.
study?
Yes,
Yeah,
sir.
that
We
is-
got it
So,
yesterday.
Professor Soumya, we got the case book, but the issue is it came so late that we could not do enough amount of justice to go through that, sir. So we would be very honest and candid on that.
Can you
Case
please
study
tell
was
me-
sent to you earlier. Unilever was sent to you yesterday.
Okay, can you please mention the title of the case just to get a confirmation from you?
Okay, which cases? Okay, can I just check?
So yesterday's file's title is 88th annual general meeting of the company.
Correct. And 3 caselets were sent to you a month ago. Can you just check? along with the annual, along with some financial
Wait.
statements.
Yes, yes, they
Yes,
have
we
case
saw
three,
that.
Classic Pen Company.
Yes.
Time for CEOs, there are some documents we already shared. Day
If you
one, day
remember, in
two,
my
day four.
last session, I mentioned that 3 small caselets are there that you need to read. Classic Case Company. One is a furniture case. Can you just see? 1 page, 2 page.
Jatin Homdekar.
Classic Pen Company developing an ABC model.
That is one. Next one.
Standard cost and variance analysis.
Can you check your email sent on 20th January, guys?
1 second, sir.
So there are almost 10 documents there. First is financial statement analysis. Second is financial analysis techniques. Then it is cash flow. It's not the bottom line. Next one is when is there cash in cash flow. Next is cash flow performance analysis. How fast can your company afford to grow? Case 3 is Classic Pen Company. Next is how to cut costs. Next one is standard cost and variance analysis. And the last one is time for CFOs to step up.
Sir, I've put a screenshot in the chat box. These are the files. You can refer it.
Okay. So the Classic Pen Company case will be slightly late. We will discuss it later on whenever we will talking about the cost aspect. Okay. The financial statement analysis readings, the 2 readings that you have. So today, the majority of the discussions will be from those readings. So after the class, you can also go through those 2 readings, okay, to complement the discussions and to improve your understanding of the subject. Okay. So if you have not gone through it earlier, it is okay, fine. We will discuss it today, and then you can build upon that going through the readings. The cash flow part, the readings that he mentioned, I think Vishal was reading out. So the cash flow reading materials will be in the next sessions that we will discuss. So it will be good if you can come prepared with that, or you match it with the class discussion and then supplement with the readings. No issues. Okay. Now let's start and then go forward. So for any company, whenever we say the annual reports that comes to our purview, those annual reports will be broadly mentions about majorly 3 types of statements that we could think about. One is basically your balance sheet. The second statement will be your income statement. The third statement of most important is your cash flow, which will come in the next. Then you have something called as statement of change in owner's equity. Okay. These are broadly the major statements that we need to understand if I want to understand the company financials in a much deeper way. And one thing, please keep in mind, whenever we are talking about company financials, company performance, it is always with respect to that particular industry that the company is operating. So I can't compare a real estate company with a software company because essentially their financials will be very different, their structures will be very different, and hence the nature of business is also very different. So always a company performance will be either with respect to its past performance or with respect to the group in which the company is operating. Okay. So whenever I will say that a company is good or bad, it is always with respect to the industry in which the company is operating, and then we can say that whether the company is doing good or company is doing bad. But From the very pure accounting perspective, if I want to summarize the entire accounting in a very simplistic manner and then trying to understand that particular accounting in a very broader and larger context. This is, if you understand the logic of this equation, entire accounting and all the statements that is there in the annual report is much and much clear to you. So this is, you can say, the one solution for all the problems that the accounting is having. So what we have in this particular equation, your assets of the company will be a function of your liability, your capital, or it is called as your equity also, and the profit that you are making over the period of time. If you will make losses, it will kill the cycle, right? Because it will be gradually a deduction over the period of time. So the assets that we say in the company, whatever I am creating to make the business happen, okay, it cannot be operated without funding source. So what is basically the funding source? The funding source is here, L and C, out of which L is the external funding and C being the equity, it is the internal funding. You getting my point? Now, this company can only grow, that means your assets can grow over the period of time, only if you are making profits year after the year. If you are not making profit, then what will happen? Your value in the capital will be started getting deteriorated. And if it is getting deteriorated, your asset strength will be also getting deteriorated. So that's why we always keep on hearing that the bottom line is supposed to be strong, the bottom line is supposed to be growing, so on and so forth. The reason is simple, that it will only meant to grow your assets and your company's strength will keep on growing over the period of time. Now, these assets that I have can be of two categories that I can broadly say. One, on which I can rely for a very long-term period, and on which I can rely for a very short-term period. For example, your inventories that you have, your cash and bank balance that you have, your receivables that has to be collected very quickly. So all these, if you see by their names itself, indicate that they are very short-term in nature and needs to be collected very quickly so that the operation can keep on working. You getting my point? Similarly, I could have my plant and machineries, my building, all the long-term fixed assets that the company is having, that also needs to run my show. So that is basically my long-term assets. So your asset contributions or asset compositions will be basically long-term in nature or short-term in nature. Is it okay? Similarly, the borrowings that I have, the liability that I will have, will be also can be earmarked under two categories. That is my long-term and my short-term. So basically, if I have a bank borrowings, which is actually a debt for your company, it is basically having an implication for a very long-term period of time. But if you have a vendor's payment due, that is your payables are due, then basically it is very short-term in nature that I need to match. So always the composition that you will see will be basically assets as long-term and short-term, and liability as always long-term and short-term. But the capital that you have is always long-term because the shareholders are expected to stick with the company for a very long period of time. So you will always try to create your assets from which sources? Umesh?
From the capital.
Ideally, it should be my capital because they are mostly the long-term money that I have. You getting my point? Or if I am going for the borrowings, then probably I will look for the long-term borrowings to create my assets. Because in any company, majority of your assets will be of long-term assets that you are having. So ideally, a company will always think that I should grow organically. Organically means you should revamp your capital to fund your assets rather than having a liability from outsider to grow your company. Is it okay? Clear?
Yeah.
Next.
Yes.
If today I happens to ask you that can you prepare your personal balance sheet? You can do that, right? How much liability you have and how much assets you own, correct? If I ask you another question, that can you please tell me today, what is your net worth? How do you will calculate your net worth? Afrozi?
Assets minus liabilities.
Simple, right? My assets minus my liabilities is basically what your C plus
Profit.
B. For a company, what is the net worth?
Total.
It's
Your-
equity.
Your capital and your profits that you have retained in your company over the period of time.
Time.
So whenever in the business discussion we heard that the net worth of the company is growing, that means what? Your capital is not something that will grow every day. The only thing that will happen that you will be pumping profit to your business, that will increase your net worth.
Net.
This net worth is otherwise called as your what?
Retained earnings.
No,
Book value.
book value. Retained earnings, please pay attention. Retained earnings is this part. The profit that you have retained in your company. So one way you can say that if the retained earnings will be good, my net worth will be good. I agree. If retained earnings are high, my book value will be also high. Agree. Getting my point? So
Yes.
first, the concept that we understood today is net worth. Then we understood the concept called as my what? Book value. Now question to you, can this book value be negative?
Yes.
When
Yes. Yes.
Yes.
Yes.
Value will be negative when my losses
Liabilities are gone.
will be piled up over the period of time so much that it is exceeding my capital altogether. In that case, my book value might be also negative. My net worth might be also negative. Now, what it clearly gives a signal that the company is a distressed company. Are you getting my point? Because you have piled up so much of losses that it has been killed your capital as well. So wherever in the discussion we heard that a company is a distressed company, what is the first step to identify this nature? The first step to identify its nature, that its book value will be negative or its net worth will be what? Negative, right? Now, what happens to those kind of companies? If a company is consistently book value negative, what happens to such company?
Become bankrupt.
bankrupt or
Now,
Insolvent.
the theories that we have discussed so far, let's try to contextually see how those theories are really applicable in the context of a real world scenario. And then we will try to understand it in a much better way, or probably it will help me to understand it in a better way. So what is in front of you is basically directly the annual report. So we will learn every concept that we will discuss in theory directly from the practice perspective and directly from the application perspective. Okay. So in the annual report, lot of descriptions will be there, and directly we will go to the main point of our discussion, that is basically our financial statements that we have here. Okay, can you see this? We are at the balance sheet. Okay. Now, in the balance sheet, and after the balance sheet, we will have what? Statement of profit and loss that we have discussed. Then after that, what we will have? Statement of changes in equity. And then we have what? Statement of
Cash flow.
right? That is what we have written on our screen when we started our agenda for the discussions. Now in the balance sheet, you will see there is a word which is very interesting. It is basically called as your word as at, right? And on the income statement, if I go down, You see the word for the year. We need to be conceptually clear on this. What does this means? Your balance sheets will be your position statement. On a particular date, what is the situation? Next day, things might change. Are you getting my point? You have a vendor payment due and you might clear that payment. So your cash will go down, your liability will also go down.
Yeah.
So your asset will also change, your liability will also change. But while preparing my income statement, I am least bothered whether the sales happened in the first quarter or the sales happened in the last quarter. For me, it is the sales only. Whether I have paid the salary in the first month or paid the salary in the last month, doesn't matter. For me, it is the salary expenses for that particular year. Therefore, income statement will summarize the story of the entire year, but balance sheet will always give you the position on that particular date. So balance sheet will be a position statement, income statement will be a period statement. Clear?
Yes, sir.
Next, the assets that we have. What we understood in our screenwriting, it could be long term, it could be short term. So this is basically my non-current assets, which is basically my long-term assets. And what I have, my current assets, which are quick assets that is available to me. So my total assets is how much? 70,517 crores. Okay, or
Can you little bit explain the current asset and non-current asset in a
current assets, which will be, for example, for inventories, which will change very fast. Your economic value that you will derive from those assets will be of short term in nature. But if you see, your property, plant and equipment is going to be in your business for a very long period of time. So you will derive the economic value over a very long period of time. That's why the name is basically non-current assets.
Okay.
So my total assets are coming out to be how much? 70,517. Now in this side, what I have? Equity and liabilities. So look at your equation. You have L plus C plus P. So L is basically your what? Liability. C is basically your what?
Capital.
Capital or equity capital. As the name you can say here, equity capital. Now this entire section is also how much? 70,517. So the equation that we have seen is actually a reflection of every real-time company balance sheet only. The total assets needs to be equal to liability plus capital plus profit. Now the question that immediately comes to your mind, that we are able to identify the L and the C, but where is that P element that is there? So P element is where? P element is with us here. What is the name? Other.
Very good.
So if you see, capital is not changing. As I told you, it's a long-term money commitment that the owners do. But do you see here that your other equity is changing from last year to this year? It is growing, right? It can only grow how? If the firm must have earned profit in that financial year, that is 2022. If the company would have been made losses, then your other equity must have been declined, right? But the other equity here is what? It is increased. That means the company is making profit in that particular year. So now, if I'll ask you, can you now calculate the net worth of the company?
Yes.
This plus this. That is basically my what? Book value of the company or the net worth of my company. Clear? Meanwhile, let me open an Excel also, so that wherever we will require, we can do the calculations as well to see the things much in a better picture. But in our discussion, we have also discussed a situation where the net worth could be negative as well, isn't it? So I have opened 2 news articles just to give you a context to the discussion. So one of the Indian Airlines company that is called as SpiceJet, not much of the international presence. But if you see, can you pay attention to the first paragraph? SpiceJet has considered its highest ever losses of 1003.2 crores. The loss, that means C plus not P minus L. The loss with SpiceJet's total liabilities exceeding its assets by 1019.5 crore. That means what? You have piled up so much of losses on that side of the equation that it has started killing your capital that is available to you. That's why the auditors question the company to perform as a going concern. You mentioned that when the losses will be up so much, the company is about to be shut down, right? So the losses will be so much means what? Your net worth is gradually becoming negative. Your book value has been deteriorated to negative. That's how the companies are distressed company and then go for the bankruptcy and the filings and other things will happen. Is it okay? Clear?
Yes.
But whenever I'm telling you the book value, there is also another name that is popular and everybody heard about in the news media. What is that? Book value and which one? Market value? Yes or no?
Yes.
So all the popular websites, whenever they pop up the financial information of the company, so currently HUL is trading at what price? 2637.95 in India. But if I want to compare the price at which it is currently trading with respect to the price that is available to me in the books. So again, I'm going back to the PPT just for a writing and then we'll come back. So what we have the book value here, correct? So this book value that I have, if I write book value divided by my number of shares, what it will tell me?
Per
Book
share value.
Per share. And this share must be trading in the market.
Yes. That is the book value of per share.
That is my what? Market price. Are you getting my point? So
Yes.
every company will always aspire that it's supposed to be traded at a better price than to the value that is available in your books, isn't it? So
Yes.
I can compare my market price with respect to my
Book value.
which is otherwise called as your what? E by B, price to book.
Yield.
So what basically this ratio is high, what it will indicate me? 1 rupee available in my book or $1 available in my book, how much is market is willing to pay me? The number of times the market values it books higher, it is basically better for the company. Okay. But if you look at it from an investor point of view, that you want to participate in the buying that particular stock, for you it is an expensive stock, isn't it? Because it has been already priced at a very higher price. So this is the first metric to understand that how a company will compare its book value with respect to its what? Market value. Along the lines, there is another concept called as your what? Market value added, popularly called as your MVA. So MVA is basically what? Market value minus
Book value.
book value. So from a company perspective, the more the MVA, it is better, right?
Yes.
Because the market is looking at the promising future of the company and hence might have priced at a higher price to the book value, and therefore I will observe a price to book ratio higher than 1. Now, this concept that we have discussed, if I just want to look at it directly from the market, let's see. Do you have here price to book ratio 12.61?
Okay.
That means what? 1 rupee or $1 available in the book has been priced 12 times in the
Market.
And if
Marketplace.
if I put the crosser here, so can you look at the definition?
Okay.
Okay, book value is nothing but net worth, and we understood that the book value is basically the net worth divided by the number of shares, or book value divided by the number of shares, which is directly comparable to the trading price that is available at that particular point in time. Can price to book ratio be negative?
Yes, maybe.
When it is negative, it is indicating that a company is a very distressed company, or the company financials are not very good as it is expected from a real-time company situation. It will be not the case. Let's look at it from this. The same airline company example that we have discussed. Which one? The company where the Boeing concern was in question. Okay. At what price it is trading now? Price to book negative. That means whatever we have discussed in that particular news article is directly reflected in the company performance, and hence price to book ratio is coming out to be negative, which is directly a clear signal that it's a distressed company to look at it.
I think it is less than 1 is negative, right?
Less than 1 can be positive also. Okay. But less than 1, it is positive. That means it will indicate you what? The book value is very high. Okay. But the market is not priced it very promisingly. That means the entire value available in the books is not reflected in the market price. Ideally, it's supposed to be always 1. But if your value is available in the books and that has been not captured in the market, then there is a possibility that the company will achieve better prices in future. For any investor, it might be a cheap proposition to buy that particular category, where prices will eventually go up and the ratio might go up above 1 at a later stage. But if it is negative, means it is clearly an indication that I should stay away, because it has been deteriorated the net worth of the company, and hence the price to book ratio is coming out to be negative. Is it okay?
Okay.
Good.
Just a question. The price means the product price you are speaking about?
Price means the market price at which the company must be trading. So whenever we will use the word called as price, that clearly will indicate that what? That the price at which the it is trading. Yes, the market price in a simpler way.
So higher the PB ratio seems to be the better.
Yeah, from the company perspective, every company will aspire that my PB ratio should be very high, as much high better it is. But simultaneously, whenever we know that sometimes stock markets go on a bull ride for a very long period of time, there might be prices are very different from your fundamentals, deviating from fundamentals for a very long period of time. This is not a good sign on this. Okay. Now, as I mentioned, your liabilities could be also long-term and liabilities could be also short-term. So if I see the liabilities here, if I see the liabilities, can you see? The liabilities are again categorized as long-term and my short-term. So the short-term liabilities are basically your what? Payables that is due, right? Very quickly you have to pay back. You might have some other financial obligations that you need to clear, overdrafts and other things, which are very short-term in nature. And that's why categorized as your what?
Short-term. Current liability.
Now, one question comes to my mind, that this other equity that is growing from last year to this year, this other equity can only grow if the profit is happening. Okay, and that profit information, from where I could get that particular information, I can capture from my what?
Statement of income.
Statement of profit and loss. Okay. Now the statement of profit and loss, if you see its very nature, the nature is such that it is actually giving you the comprehensive informations along with the notes where I can go and see the details of those particular transactions that is happening, heads on which the money has been spent. But it is not giving me the profitability positions from a decision-making point of view. Decision-making point of view means what? That how much is my margins? Because if I'm talking into a meeting where I'm dealing with the sales team, now the sales team will be always be talking about the margins that they are getting, because the sales team is least bothered about whether the company at an aggregate level is profitable or not. Although they will always try to do that, but always the discussions happens about the gross margins that we have. But the moment I will be into a company board meeting or a company senior level meeting, there will be always be talking about the profit margin aspect. Are you getting my point? So therefore, the overall profitability of a company positions, if I want to look at in deeper sense, I have to be very careful and to be dismantle this particular structure in a more meaningful way to understand the implications. Okay. Now we'll spend some time on that and try to understand what are the different profitability avenues I could explore to understand the company performance better. So again, I will go back to the writing pad and I'll come back again to the discussion forum. Just give me a second. Okay. It takes a fraction of a second to be live, so maybe whenever I'm changing, please bear with me, because it will take slightly a fraction of a second to the screen to be visible to you all. Now, let's understand the concept. So, basic point that we have started. Sorry. The basic point that we have started is basically my A will be equal to L plus C plus P. And this P will be available to me from where?
Income statement.
Income statement. So I need to understand this income statement in slightly in a deeper way. And my top line will be always basically my what?
Revenue.
Let me prepare a statement also. So my top line will be my revenue. Once I have my revenue, then what is the direct cost to generate that particular revenue needs to be factored out, which we will call as what?
EOGS.
COGS. So COGS is basically your what? Your opening
Stock
opening-
plus purchases. Inventory plus purchase
Minus closing stock.
Sir, could you please explain in a simple way profit and how it differs from revenue? Both looks
Okay. Revenue
maybe
is
a
what-
basic, but I just want to.
Yeah, in a very simpler note, revenue is your sales. But
Your
profit
savings.
profit is sales minus cost. Okay, so this revenue word that you have here would be called as your sales could be called as your turnover. Various names could be, but it is always before approximating the cost that you have incurred to generate that. The moment you factor the cost, it will show you the profitability position that your company is having. So in this case, if I am factoring into the COGS, basically I am trying to factor the direct cost involved in my company operations. Okay, direct cost involved in my company operation. Now, if you see, if you are a production firm, for a service sector firm, it does not matter much because you are not dealing with any inventory and other things, right? You are an advertisement agency, let's say. There you may not be requiring much of the inventory, but if you are into a production or into a construction, definitely you will have to deal with the inventory level as well. Okay, and you will always be saying that there will be some kind of production cost also. Do the production cost is a direct cost? Yes, it is a direct cost. How the production cost get factored here? Because the moment you are saying your closing inventory is such that closing inventory must have been arrived because of your production process, and that must have been already factored the cost involved in that production process. You getting my point? So this revenue minus costs will lead to my first layer of profit, that is basically my what?
Gross profit.
Gross profit.
My gross profit. Okay, and this gross profit, if I compare it with respect to my revenue, so my gross profit with respect to my revenue will tell me my what? Gross
Margin.
GP,
Gross
GP
margin.
ratio.
Yes. Now, if you are into a company where you have product portfolios ranging from different types of product, for example, here in case of us, we have HUL. Similarly, you might have a situation where your company is dealing with multiple products, and all products may not be priced at the same level, right? Because of the different market segments that you are looking at. Now, if your sales team is more active in selling those products where gross margin is lesser than the company level gross margin, then definitely your bottom line is not going to do good. Are you getting my point? Because the overall contribution of the revenue will be from those category of the products where the margins will be lesser than the company level of margin. As a company, I will try to always look at the margins that my company aggregate level is having, whether at the product level, I have the product mix which is supporting on a higher side to the products which is of a gross margin higher than the company level gross margin. If that is the case, then only I can increase my bottom line. Are you getting my point? So because my gross margin is supposed to be taken care of in proportion to higher side of my aggregate company level gross margin. So this is your gross profit. Once you have the gross profit, then you started factoring into your operating expenses that the case is having. And pay attention, whenever I'm saying the operating expenses of your company, most of the expenses are basically indirect expenses. For example, your advertisement expenses, for example, your R&D expenses, your head office, your salaries, all these are basically will be factored in your operating expenses. Those are basically linking towards what? Mostly linking towards your operating expenses of your company, which after that will result to me something called as your what?
EBITDA. Earning before income tax and depreciation.
Before interest, tax, depreciation, and amortization.
Amortization.
So just to give you one hint, Mr. Chinnaswamy, your question. So I'm using the word earnings here. The moment I'm using the word earnings, please pay attention. We are gradually talking about the excess of revenue over the expenses. So which might be of different form. One form is gross profit, another form is EBITDA. And finally, your bottom line, which is your net profit. So once you have your EBITDA available to you, then the next step will be to talk about what? Next step will be talked about your depreciation and amortization. I think Mr. Mahesh must have given you some basic about your depreciation.
Yes.
and amortization. These are your non-cash expenses that you are charging out of your what? EBITDA. The moment you charge your depreciation and amortization, you are reaching to the point which is basically your what?
EBIT, EBIT.
EBIT. Now, once I'm in the EBIT, then basically I'm more interested that how much is my cost
Finance
associated
cost.
with my finance cost. So I will deduct what? My finance cost or interest cost. I will also add back how much, whatever is the other incomes that I have, right? Because other incomes should not contaminate your EBIT. That's why here we have only taken what? Revenue of the firm. We have not considered the other incomes, right? Now, these other incomes should not contaminate my EBIT, and this EBIT is otherwise called as your what?
Earning before interest and tax.
Yeah, that is the name, but it is the indication of your what? Pure indication is called as your operating profit. So if I'm saying operating margin means I'm talking about which margin?
Operating margin, EBIT.
EBIT margin I'm talking
EBIT over revenue.
So most of the discussions, if you heard about the discussion hovers around my operating margin. So the moment they are saying operating margin means be careful that they're talking about indirectly the EBIT position. And why so? Because here it is, you are purely comparing the revenue with your operating expenses. You see, I have not touched upon the other income so far. Now I am touching upon the what? Other income.
Other income.
In case of a company, there might be some adjustments related to exceptional items. What do you mean by exceptional items? Maybe if you think your company is dealing with Forex, okay? So the Forex rates keeps on fluctuating. So at the end of the year, the currency that you have might have the value might have gone down also, value might have gone up also. Are you getting my point? Now, this is something that I should not capture anywhere ever. You might have, let's say, dealing with certain kind of inventory, which is supposed to deteriorate with the weather conditions. Okay, depletion will be happening, right? Now, these things are exceptional items. So in case of a company, there might be some items which will come under what? Your exceptional items, which might get adjusted after this, you calculated your what? EBIT. Once you have calculated this EBIT and adjusted it for the other things, then you are reaching basically what? Earning before tax.
Tax.
Then you minus your tax. Then you reach to the bottom line that we popularly called as your what? PAT.
After.
Or you can say also it is also called as your what? Earning after tax. Right? So now I have profits which is clearly visible to me, which is giving me different kind of indications which was not available earlier. I can say now the margins available to me only factoring the direct cost, the margin available to me after factoring the OPEX, operating expenses, the margin available to me as a pure operating profit, that is my EBIT, and my final bottom line, that is basically my what?
PAT.
My PAT.
Profit after tax.
Profit after tax. Right? So what are the different types of profits now we have? We have gross profit, we have EBITDA, we have EBIT, and we have what? PAT. Right?
Yes.
One question to all of you. Can it be happen that my EBIT is negative, but PAT is positive?
Yes, possible.
Yes, yes.
How can it be possible? Because of my other
Income.
incomes. Now, let's say you find out such kind of company where you find out the EBIT margin is negative, but PAT margin is positive. It is not something that you should be happy of. Because PAT margin is positive, everybody will jump to the conclusion that the company is profitable, right? But essentially, the company is making money from other sources than to the core business operation. I should be very careful in such kind of company. That can only happen if I dismantle the profits across the scenarios and then try to dig deeper and try to understand that which profit is making a case of better understanding of the company.
So
Yes. Can somebody control the sound, please? You can keep yourself mute, and whenever you are asking, you can raise your hand and ask questions. So, gross profit margin, EBITDA margin, EBIT margin, and PAT margin. One thing, whenever you will be reading any business discussions, and you find a company is an asset-intensive company, that means automobiles, oil and gas, constructions, real estates, they are basically asset-intensive industry, isn't it? So if you are asset-intensive industry, definitely your depreciation and amortization is going to be very high, which will make a drastic jump from EBITDA to EBIT. So whenever you will read those kind of company reports, maybe in the online media and the stock market, they will be always talking about my EBITDA margin is so much, EBITDA margin is so much. But if you will be reading a discussion about a service sector firm, a software company, they will be always talking about my EBIT margin. Because for them, depreciation and amortization is not such a big deal to happen. So be sensitive that which kind of company I am looking at. If you are looking at an asset intensive company, drastic jump from EBITDA margin to EBIT margin, you should not be worried of. Why? Because definitely they will have a higher deduction of what? Depreciation and
Amortization.
right? But depreciation and amortization by their very nature is non-cash expenses. The money is still where? In the business. Although as a deduction, as an accounting treatment, it is looking me as a deduction, but the money is still in the business. So depreciation, EBITDA margin and EBIT margin, if you see a drastic fall, you should not be worried of, because you know that depreciation and amortization in certain category of the industry are going to be very high. Clear now?
Yes.
Now what I will do, we have so many types of profit. So let's try to understand the relationship of profit in a slightly better way. But before I will go there, can you please tell me this opening inventory and closing inventory, the arrow mark that I made, in a real-time basis, what I can call it by other name?
Closing, opening stock and closing stock.
Opening minus closing, what it will tell me?
Consumption.
Available stock.
Current
Change-
inventory.
Change in my inventory, right? My opening inventory was X, closing inventory is this. Opening minus closing will tell me what? The change in inventory. Now that change in inventory could be positive, the change in inventory could be negative, which will give me an indication. Looking at the positive or negative sign will tell me whether I end up with more closing inventory, that means the change is negative, or I end up with a lesser closing inventory, that's why the change is positive. Is it okay? But opening minus closing means what? Change in inventory. So whenever I was showing you the real-time balance sheet as an example, if I go there, can you see the word here? Change in
Inventories of goods.
that means what? Opening minus closing has already been taken care of. So what you read in theory and what you practice are not different. They are same. The only thing is that nomenclature is changing. So if for a moment, what we will do, sorry. Changes the screen changed very quickly. Yeah, this is the statement that we are in. Right. So Give me a second. Just give me a second. I'm making the stops here just to make the screen adjustment. Otherwise, it is keep on fluctuating. Any questions so far?
Sir, one question.
Yes, go on, please.
In the previous profit, different profit things you mentioned, no? EBIT, and profit after tax. The dividend expense will be calculated, will be deducted from the PAT or what?
After PAT, definitely. So the equity shareholders dividend will be only will be taken into account after the PAT.
Okay.
And everybody pay attention to his question that whenever I am saying that your dividend will be deducted after PAT, so don't you think it's a limitation of accounting that you are factoring the cost of debt, which is basically your finance cost, but you are not factoring the cost of equity because you are always treating them after what?
Tax.
After the profitability position is known, then only you are going and talking to the equity shareholders. But otherwise, do you consider equity shareholders? No, you are only considering the debt cost as one of the important costs to approximate. So that is, you can say, in one way, is the limitation of financial accounting that we fail to accommodate the cost of equity shareholders, and we only give due attention to whom? To the debt as a cost to be factored in the income statement and other things. So on a quick note, can you see the Excel?
Yes, sir.
Yes.
So what I'm doing, I've already shared with you the link for that annual report. So what I'm doing, you be on the Excel file. I'm directly taking the figures and trying to paste it on the Excel file. So our calculation will be on the Excel file only. Okay. So I'm directly taking the figure there, and because I can't operate the two screens, I was trying, but I could not operate them. So I'm directly taking the figure here. So this is my revenue from operations. Then I will have my
COGS.
That my COGS. So my COGS as per the HUL will be what? My cost of material. Then I will have my purchase. Then I will have my what? Changes in inventories.
Inventory.
So figures I'm directly tracking. That is my cost of material. That is my purchase. And then I'm taking my COGS part here. So COGS is negative. What it indicates to me? It indicates to me that closing inventory was higher than opening inventory. So my COGS. My COGS will be of how much? COGS will be this. So if I want to identify my gross profit, can I do that? So my gross profit is clear to me. That is basically my revenue minus my COGS, right? Now, once I have my gross profit, then I will have my OPEX, operating expenses. So my operating expenses are under the heading of what? Employee benefit expenses. Then I have what? My other expenses. So my employee benefit expenses amounts to how much? And my other expenses is here. So that leads to me which profit now?
Operating profit.
It is basically my what? EBITDA, which is gross profit minus my
Operating expenses.
operating expenses. Once I have my EBITDA, then I am factoring my depreciation and amortization. That is also available in HUL directly. So my depreciation and amortization is 1019. That leads to me my which case? EBIT. Now for a moment, I'm going from the Excel file and I'm trying to show you the income statement. So what are the things so far we have done? We have calculated the EBIT margin, not EBIT margin, the EBIT. But can you see here in the normal income statement, other income is here on the top line, close to the top line. But here we will be doing the other income, we will take it to which place? We will take it to the after the EBIT, because we don't want to contaminate our operating profit with the other incomes, right? Now, you see here, another thing that we will factor is what? My finance cost after the EBIT, because that is earning before interest and tax, and this interest is basically your what? Finance cost. And then, as I mentioned to you, there are some exceptional items are also there, right? We discussed that in our theory, that there might be some exceptional items that has been there in the company's case, which we need to be also taken care of. So now, what are the things we will take care in the Excel file? The other incomes we will take care, right? So other income is basically how much? 258 as a positive note. We will also be interested in what? We will be also interested in our finance cost, but of course, finance cost will be as a what? Reduction. Right? Then I will have my what? Some exceptional items are also there, and that exceptional items net is coming around to be a right. So now you see here, this is your profit before tax. Then you reach out to what? Your tax expenses. Tax expenses is also given you under two heads. What is that? Your current tax and your deferred tax. Now, in case of Gulf countries, tax may not be a very important aspect to look at it, but in the other countries, definitely the corporate tax regimes that is available will have some amount of impact on the cost. But in case of the current context in which you are operating might be, will be not that much of effective as a tax as an important element. So what we have now here, the point that we are discussing. So we have EBIT, right? Then we have what? EBITDA. Then I have what? My gross profit. And then now what I will have? Earning before tax. So my earning before tax will be of how much? EBIT minus finance cost plus, right? Once I have, then I have my tax expenses, and finally my bottom line that I'm looking at is basically what? That is basically you're coming out to be what? The PAT. So we have taken the same figures from the HUL's report. The only thing that we did is we dismantled the thing as per our own requirement to justify, right? So if I now ask you that for every case, can you have the margins with me? So my GP margins will be basically my, right? My EBITDA margin, my EBIT margin, till EBIT margin, we are not influencing it with the other incomes, but the moment I will be my bottom line will be influenced by both revenue also and what? Other incomes also. Clear?
Yeah.
So this is the case that we have, right? So approximately, I'm saying that we will have a 16.95 as my final profit margin that I have, right? My gross profit margin. Agreed. We have calculated the
EBIT.
we have calculated the earning before tax, so we can calculate. And then we have what?
PAT.
Now, what we will do, the entire accounting equation that we understood, we will write it vertically. Okay? Now, we will assign some task to our fellow friends. So now, Ashwini and Prashant, okay? Ashwini and Prashant, let's say, are our major equity shareholders. Okay, Ashwin and Prashant? So,
Yes, yes.
Ashwini and Prashant are contributing what to our company? C plus P. So P is their retained profits and C is the capital that they have put it in my company. Correct? Huh? Now,
Yes.
we will take Rajesh and Vishal as to other stakeholders. So Rajesh and Vishal, you remember your names and your groups, because I'll come back to you to the questions. So Rajesh and Vishal are actually some bigger players in the market. They also give loan and they also participate in my equity. That means they have purchased some equity also, and they are the bankers also who give me the loan whenever I need a long-term loan for my expansion. Is it okay? Rajesh and Vishal? So
Yes, sir.
the role that we have assigned to Rajesh and Vishal is slightly bigger, isn't it? Okay, right? Now, these are the outside stakeholders who have participated in my company. But what about Ashutosh and Abhijit, who are the managers we will start, and we will start with Ashwini and Prashant.
Profit.
Yes, Ashwin, as an equity shareholder, which profit is of interest to you?
Equity PAT.
Why?
PAT.
Yes, why?
Because after that only we will get dividend, right?
Very good. So he is more interested in what?
PAT.
Because the entire dividend game, or how much the asset will grow with respect to addition of retained earnings. Let's say your company is not paying you a single dividend, but still that company is of interest to you, because anyway that money is retained in the company and assets will grow, which will of course transfer the responsibility to Ashutosh and Avijit. But as an equity shareholder, I am interested in what? PAT. We will go to our other stakeholders who are Vishal and Rajesh. Now, Vishal and Rajesh, which profit will be of interest to you?
EBIT,
EBIT. Why?
because it is showing after deducting all the expenses, we will come to know what exactly the margins the company is doing. Because
your interest is in interest, isn't it? As debt providers, I can only pay you sufficient amount of interest after a healthy EBIT margin. Otherwise, there is no, right? So if I'm paying interest after making losses, then it is not a good sign. And as he said, that after taking care of everything, whether the operation is viable or not. Are you getting my point? So from their perspective, they will look at to which profit?
EBIT.
EBIT. Now comes to our other stakeholder who are internal to the company. Who? Avijit and Ashutosh.
Gross profit.
As a manager.
PAT is the one. PAT.
PAT, okay. Pay attention. One thing you are missing. The moment I asked this question, you could think about something else. In this equation, if I ask you simple question, A divided by C plus P versus A divided by long-term loans plus C plus P. Because your assets could be created from these are the sources only. Either it will be created from the equity money, or it will be created from the long-term borrowings plus equity, right? How much of your assets will be created from current liabilities? Very less, maybe 10 to 15%. Rest 85% of your assets will be created from these sources only. Are you getting my point? Now, if you are look at the bottom line, you have already the answers in your hand. The moment I have mentioned the first part, the bottom line was interested in which profit? PAT. Whenever I show you the second equation, these people were interested in where? EBIT. So if my asset creation is majorly driven by these people, then as my profit responsibility, it will be cannot be unidirectional. It has to be what? Multidirectional. It might be of EBIT and it might be of PAT. Depending on whether my company is a zero debt company, that means A is majorly funded by equity. Hence, equity and other equity taken together. Equity and other equity is otherwise called as what? First slide.
Net worth.
Net worth. So can we otherwise say that ROE or return on net worth meaning will be same? Agreed? So some websites might tell me return on equity, some websites might tell me the return on net worth, but the meaning will be same because we understand that C plus P means what? Net worth. Now, they said that as a what do you say, long-term loan providers and also the equity part. So I heard about something called as return on capital employed. Yes or no? Or return on invested capital. Which profit was of interest to you? Right?
Bit. Yes.
What is the denominator then? Borrowing. Plus
Net worth.
net worth or equity capital. Clear? Huh? Only thing you have to pay attention here, that a company, instead of taking debt, might go for financial leads. Why? Because let's say you are an airlines company, instead of taking loan to buy planes, you might think that let's negotiate with Boeing, because Boeing has an interest slightly lower because their interest is also to sell their products. So if you see personal loan versus a vehicle loan, the interest rates differs, although you are only taking the loan. So if I'm borrowing directly from the market, cost will be definitely high as compared to if I'm going for a financial lease. So financial lease is an alternative channel to fund the companies. Okay. So if you find a company balance sheet where there is a long-term liability as financial lease, is it an alternative way to fund also? Yes. So
Yes.
instead of if the borrowings are there and also financial lease is also there, I should also include that in my calculation as well because it has been played a major role to fund the assets as well. So wherever you are examining a company and you find that the financial lease element is there, you be careful that you should not omit it because it is not just written as a borrowing heading. It is a kind of borrowing. The only thing is that company is intentionally using it to lower down the funding cost. But it has a role to play to increase my assets. It is an alternative way of borrowings. Hence, as a smart analyst, as a smart analyzer, I will always include the financial lease also as a part of my what?
Capital employed.
Yes, borrowing element. Okay. Because in borrowing financial lease also I will be paying interest, which is a kind of interest cost also. So that has a burden on my EBIT at a later stage. Are you getting my point? So be sensitive to this example. Keep in mind because in no textbook or no website or something they will mention it explicitly. It is the practice. Employing the assets which have been created by equity. So that by total asset is okay with me. But if my company is funded through debt and equity, then my assets have been also created by debt and equity. Debt and equity means I am interested in the operating profit, that is EBIT. So my total asset will be basically what? EBIT by total asset. Is it okay? Huh? Clear?
Yeah.
So you don't have to remember the formula if you remember this logic. If you can remember this logic, you never in life have to remember the formula. Because you only told me based on which role, which profit is of interest to you. That as an equity shareholder, I'm interested in PAT. As a loan and equity, I'm interested in EBIT. As a manager, I will look at how my company has been financed. Right? Accordingly, I will choose my numerator. Denominator name is already available to you. If it is equity means denominator equity. If it is capital, denominator is debt and equity. If it is asset, denominator is asset. Numerator is purely my logic. Okay. So try to understand finance in that way. It will be helpful. It will be long sustaining. It will be, what do you say? As a logic, you can build it up for a very long period of time. Is it okay? Next. What we understood in the previous discussion that ROE is basically backed by
Exactly.
Equity capital. Equity capital plus
Capital.
profit. Plus profit.
Okay, total equity capital. I beg your pardon for my writing quality. It might not be looking very great, but this artistic touch is because of the digital pen that I'm using. So I think wherever you find it difficult to read, feel free to ask me. Group the ROE.
Our total equity should be lower.
Okay.
Increase profit.
One by one. Because we'll write, others will also start thinking. So total equity is low. But when you say sir, total equity is low, A equal to L plus C plus P. So you are saying that C plus P is supposed to be low. If C plus P will be low, then you have to shift your focus to whom?
Liabilities.
L.
L is
Not good.
which part of L actually creates your assets? Borrowings.
Hmm.
So the moment you are saying that my equity dependency will be low, that means your debt will be
High.
High.
But now one more trick thing that happens, if debt will be high, interest cost will be also
High.
Finance cost.
interest cost will go up. Then my jump from EBIT to PAT will suffer.
Yes.
So if my interest cost will go up, my PAT will go down. But PAT is in your numerator. If PAT will go down, can you improve the ROE?
No.
That means always a basic logic tells me that my PAT margin should be high. That is the basic thing. But now the logic that we have developed from the denominator side gives me an indication that if the equity will be low, debt will be more. If debt will be more, and hence cost will be also
More.
high. If finance cost will be high, PAT will be low. Right? So that means what? You should borrow, no problem, but the borrowing cost supposed to be
Yes.
Low.
Lower price.
so your
Lower rate.
cost of borrowing, that is your basically interest. So cost of debt is
Wherever the operating cost would be low.
Gross profits.
Okay, hold on. That is a different point altogether. So you are saying that the operating margin supposed to be high, right?
Yes.
Operating margin to be high, but here everything you are comparing from profit point of view. I'm asking from pure revenue point of view. So operating margin to be high, very good point. Everybody agreed, right? My operating profit will be good, so my net profit will be better.
Yes.
But if I'm comparing two companies from the revenue side, with respect to what I should benchmark, not from
Assets. Sales price.
Yes.
Cost.
Assets.
Who
Previous
said that?
year's revenue.
Previous year revenue will show me the growth trajectory. But
Cost of goods.
Cost.
Purva,
Or
I think Purva
reduce
mentioned,
operating expense.
Asset turnover.
he said my asset utilization efficiency. As a manager, if you are managing a big ship, the revenue, and a small ship with higher revenue, which one I will prefer? Definitely where the size is lower, right? So in your place also there might be online retailers and the brick and mortar retailers. Why online retailers are being sustainable? Because their asset dependency is quite low. Why service sector firms profit margin can be very high? Because their asset dependency is very low.
Yes.
So I'm generating revenue, but what I'm investing in, because to generate that revenue, I have to employ asset. So if in any case I can prove that I'm utilizing less asset and creating more revenue, then definitely that is a better company. And that company is basically utilizing its assets very efficiently, right? And I don't know how you experience the example that I'm giving now in the context of your country of present operations. But recently I've seen that many of the new smartphones that comes, yeah. So cost of sales is less, your operating margin will be better,
Yes.
right? So point number 7 is in a larger sense taking care of it. What else?
Sir, it will also help if we pay off any loans or something to the lenders.
Loan repayment is not your expenses. Loan repayment is a reduction in liability. What you are basically asking, if I'm just saying, taking one moment, please, from others. So what you are asking, the confusion is here. So let's say I will take 500 or 5 million or 500 million loan, then definitely my liability will go up and my cash or bank will go up. Are you getting my point? Now let's say the interest rate is 10% and repayment schedule also 10%. Repayment schedule is how much? 10%. Interest is also 10%. Okay. because it is EMI plus interest, right? So the moment you will pay in the first year of operation, how much you will liable to pay? How much your cash will go down? 10% of
So
500
450.
million. So that will be
450
450
first year.
plus 10% of it.
50. 50 is interest and 50 is loan repayment.
So 50 you will pay as interest and 50 you will pay as what?
Loan repayment, principal.
Principal amount.
Repayment. Principal amount.
400.
Side, your cash will go down by 100,
100.
right? So at the end of the next year, how much is your loan now?
450.
450.
450.
How much is your profit will go down?
No.
50.
So your profit will go down by 50. Liability will go down by 50. So this side net total downfall is how much? If your equity capital will go up, your denominator will go up, ROE will go down.
Okay.
What else?
So in terms of the other income, I think it may not be a dependable source, but if it is contributing to the operations in a substantial way.
Very good. It may not be very sustainable one, but what's wrong in other income to be improved? Huh?
So because I'll just take a minute because I will give you an example which I understand from my experience, that for a food and beverage industry which is into food processing and food, they have this, because I'm talking about Americana Foods, we dealt in operations with them and they were trying to sell the proceeds of the used oil and other WIP like items which used to be incurred in the manufacturing of the goods. It used to also contribute on the top line of the company.
Right. It will contribute to the bottom line.
Yeah.
Now see, these are the 9 points that you have given to me. Purely based on the logic of this simple numerator and denominator. Isn't it? You have not gone for anything. You have just built on the logic to give me that, okay, these are the 9 options possibly could happen, which might be helpful to me. Let's start with the very basic one. You told me that the PAT margin is supposed to be very high. The PAT margin, if it is going to be high, then PAT margin I can measure how? PAT by revenue. Yes or no? Next, you said that this revenue Okay. Denominator will be what? Whose name it is? Like asset turnover, revenue must be in the numerator, asset must be in the denominator. Capital turnover, revenue must be in the numerator, capital must be in the denominator. It's a simple technique and remember. So wherever you heard the word turnover, revenue must be on the what?
Denominator.
Denominator.
So this is your technically called as your what? Profit margin, right? Now, you told me that sir, these assets that you are talking about, we have to be very careful how we are funding those assets. And you said that you always depend less on your equity. And you said while you depend less on the equity, please also look at the debt because your assets are funded by L plus C plus P. So the total assets that I have will be funded by my total equity capital. If this metric is high, what it indicates? If this ratio is high, what it will indicates? Debt are more. Out of your total assets of 100 crores, if you have funded majority of your part from the equity capital, then debt dependency is low. But if you have funded less from the equity, that means you are more funded from
The equity.
debt.
Debt.
This is called as your what? Financial multiplier. Now basically what? EBIT by revenue. Yes or no? Operating margin, operating profit. Operating profit is EBIT. EBIT by revenue. Now, you said that sir, this EBIT that you are saying, but it is linked to PAT. Within EBIT and PAT, what are the things involved?
Interest and
tax.
Interest and not interest is there.
Tax.
Tax will come after EAT, EBT, earning before tax. But from EBIT, two things are involved. One is basically your other income, and another thing is basically your
interest.
cost of debt. Yes or no? So my earning before tax and earning before interest and tax. If this metric is high, that means what? Either your other incomes are good or your interest cost is low.
Yes.
Because that is the two things that is going to happen between EBIT and EBIT, earning before tax and earning before interest and tax. But somebody has also said that this earning before tax that you are saying, by the time you are reaching to the PAT, you have one thing involved. What is that? Tax.
Tax benefit.
as a operations manager, we will be less interested on these things because this is a very long-term financing decision of the company. You can't just overnight change the different equity mix of your company. Getting my point? You are more interested on the margin and the sales. It is the playing field of what? Yes or no? You are more interested on what? What is the day-to-day language that you keep on hearing in the business segment? It is basically your sales and margins, isn't it? So if I'm talking about from the sales and margin point of view, then basically these two things are important. Now, who speaks from the sales and margins point of view? Mostly? Who speaks
The
of
CEOs, the CXOs.
CEOs and CXOs? Who listens to it every day? Managers. Managers are directly responsible for
Sales.
assets.
Asset.
What is under your management? It's your assets. Your result is basically your sales, but what you are using from the company side, assets only. Are you getting my point? Whether that asset is your inventory, or that asset is your cash pile, or that asset is the advertisement that you are spending, but the money is that supports you, then only you are making that sales, right?
A.
Who thinks if I take margin and the sales efficiency, that is what the manager has been evaluated at the end of the day. All appraisal questions boil down to these two things, isn't it? The margins and the sales. That is basically the return on asset.
Assets.
Clear now? Next thing. Give me one premium biscuit brand. If you are any brand that you are in India, example, if I'll give you, you may not appreciate, but
Parle-G.
Britannia.
McVitie's.
Parle-G.
Britannia.
Britannia Parle-G, right? Or is Britannia Tiger and Parle-G small biscuit. Price point in which it sells in India is 5 rupees. And from a dirham perspective, it will be very less. Okay. Now, in case of Britannia, I could have also the Oreo or Dark Fantasy as some premium brands, right? In India, every popular household is known about a car called as Alto, which is prepared by Maruti, right? And I could have a Mercedes or Audi, very high-end car. I could have a Fair and Lovely, woman's favorite, or I could have L'Oreal. The examples that I have given you, one is a volume game and one is a margin game. because your margins are not viable. But if it is from the margins perspective, this will be the main game changer because your margins are very high and you are not worried about the volume much. But imagine if your marketing strategy is such that you can sell the same biscuit ranging from a 5 rupees packet to 50 rupees packet. Then you have both volume game also, margin game also. Or you can have a product portfolio ranging from cheap products to very high-end products for all market segments that you are present. Then you have a muscle power in the margin also, you have a muscle power in the volume also. Both will contribute towards high ROE. So I have to look at this ratio, not just from the figures. It is purely how the decisions has been taken at the company level and getting executed at the down the hill. So whether it is margin game, it is a volume game, it is a financing game. Financing game least bothered. Why? It is a very strategic choice that the company makes, depending on the capital availability that the company makes. If margin, then I have to see where that margin is coming from. It is coming from the operating efficiency. Is it coming from tax efficiency? Is it coming from the cost burden and other income sources like the example? Strategy professor who is teaching you, everything boils down to formulas at a later stage. Then only you can make a whole lot of window of framework that okay, how strategy is coming to marketing and how that marketing is coming to finance. Is it okay? Good?
Yes, sir.
Okay.
Any questions? No questions? Yes.
Sometimes we use, sometimes we use this ROI and ROE are the same or they are used in different context.
They are different, sir. Whenever I said ROI, you see it is the borrowings and the equity taken together. And the profit that you are benchmarking is EBIT, operating efficiency. But whenever you are talking about ROE, you are talking about the bottom line. So in the meetings, wherever you might have been encountered the question of ROI or ROC or RO, all this, it is purely people are interested in the operating efficiency of the company. Okay. So it is mostly the discussions will happen either on the sales side or on the cost side. All the discussions, if you would now reflect on those meetings, the discussion agenda points will be mostly on the revenue side or on the cost side.
Okay, thank you.
Yes, Abhijit.
Yeah, one question, please. When we talk about the WIP, work in progress,
And since they are under production, so till the date of end of the year, whatever the cost has been approximated to those products is basically your cost of work in
progress.
So that is basically your work in progress will get factored before you are reaching the gross profit margin.
Okay.
But
Okay.
anybody here is from the real estate sector and construction side? Yes. So, okay, Abhijit, Vishal, let's take the question of Rajesh, then I will explain. Yes, Rajesh.
Sir, for example, in our company, we are manufacturing unit. So our management mostly they talk about gross margin always. Whenever there a month-end sale is happening, they're just talking about gross margin is less or more. But normally, what is the exact in real? What do we have to refer? Gross margin or net profit or what exactly? Actually, we are confused on this.
I got your point. Now, imagine, out of these profits, why they talk like this? There is a logic. Why this discussion happens like this? There is a logic. Now, you see, all the kinds of profit that we have shown, gross, EBITDA, EBIT, and so on, so forth, which is directly day-to-day basis monitorable. You tell me? Which profit is monitorable day-to-day basis? It is the gross margin. Other things like your advertisement expenses, your audit fees, your travel expenses, transportation expenses will come with a lag. That's why on a monthly basis, I can't compute my EBITDA or EBIT. That can be only done at a quarterly level. So the first information that is available on my table is GP margin. Now, GP margins, if it is excessively high, then only I can factor those margins which is coming at a later stage. All these expenses. So if my GP margin on a monthly basis is getting down, then I'm going to be in serious trouble at the quarter end. So the pressure always on the monthly discussions is on the GP margin because they want to maintain it at a very high level so that the other margins can be taken care of. And if you are into a business which is cyclical, okay, or a business which is seasonal, then definitely the pressure is going to be tremendously high in those seasons. Because rest seasons, operating expenses will keep on happening, but GP margin may not be sustainable. So the only period at which I can push the things up is during the season or that cycle that is happening. Okay. And when I was asking that question that how many of you are from the construction or the real estate, in case of construction and real estate, some projects are very ongoing. So if you are creating a building or a tower, it will take 2 So it is a 1 hour break. So please approximate the same timing at your timings. So at your time, I will log it at. Is it okay?
Yes, sir. Thank you.
Yes, sir.
Yes,
Yes,
sir.
sir.
Okay, sir.
Okay, sir.
Sumya sir, I'm calling you. Sumya sir, I'm just calling you.
We can break for lunch now, right?
Yes.
I don't know.
Okay, thank you.
Yeah, thank you, sir.
Yes, yes, we can break.
Mr. Mahesh, Manoj this side. I have started the session. Yeah, good, good.
Yeah, yeah. You
Session
enjoyed the
was
session,
good.
Manoj?
Yeah, yeah.
Chalo, good. Abhijit?
Yeah, initially it was like unable to get it, but once it is started, we started to get the grip and getting the concepts clear. It was
Anyway,
much
it's
better.
fine. So it will take some time. It will take some
Yes.
time.
Yeah.
Slowly. Yeah. Vishal?
या सर वो अभिजीत ने सही बोला स्टार्टिंग में तो एकदम से ऊपर से निकला बहुत कुछ लेकिन लास्ट में आते आते थोड़ा कनेक्ट हो गए हम लोग वापस
बट मेरा तो सेशन अटेंड किया उसमें कुछ मिला कुछ काम आया नहीं
हाँ उससे काफी
वो बहुत काम कर रहा है
Mahesh sir, your first session was really good connect to Professor Soumya's session. Thanks, you took that
But I
session.
told you last 2 weeks back was you have to start practicing. Please go through these Unilever. What I taught you was basic, but this Unilever is the sheet which you should keep on going through it again and again. Because we are not teaching you accounting, we are teaching you how to read these audited statements. That is important, please. But after sessions, if you just don't do anything, then it will not add value. You have to put that effort from your side also. Okay. Very important, please. So this balance sheet, this audited statement.
equity only, you don't have to depend on debt. But if you are a very young, not so stable kind of company, then you might have to also depend on debt. Okay. So how much debt I supposed to take? That will depend upon that how much I can. I want to go for more of borrowing something. If you have a supportive, what you can say, operating margin, then there is no harm of going for a debt. That is one. Cost of debt also matters. Maybe the economic environment in which they are operating, the cost of debt is cheaper, and that's why they are going. In any stable economy, if we pick up, usually the cost of equity will be always higher than the cost of debt. The reason is simple, because in case of a debt, when the liquidation issues will come up, the debt providers will have first bearing on the assets. So you will first disperse their money, and then whatever is remaining is going to the equity shareholders. So that's why debt is having some kind of mortgage or backing. That's why the cost of debt is lower than the cost of equity in any stable economy you will think of. That is the reason one option is that I will go for a cheaper source of funding. So instead of equity, somebody might thought of to go for a debt.
Yes, sir. You are like very rightly, I think, explained in terms of the fact that this business houses I'm talking about, there are basically 2 to 3 generation old businesses. That basically talks about the stability of their operations. And I think economy here is not really fluctuating so much, being energy dependent, oil dependent. So I think that's why I think maybe they be borrowing rather than putting equity. So I always had that question in my mind of why they're not putting their own money and rather.
How we can see those things from the real time in terms of calculation and to looking at the figures to some extent. Is it okay? So now you see whatever the things we have discussed. So what are the parameters I will require? I will require the total assets, right? I will also have the revenue with me, right? And then we will see that how the return on equity we are talking, and how we can link it to the different aspects that we have discussed so far, right? So meanwhile, when we are waiting for the others to join us, so here from the statement, I have taken those figures directly to the Excel so that it will be quick enough to go for the calculation part. Okay. So here I have taken some parameters like equity share capital, other equity, total assets, current assets, liabilities, inventories, so on and so forth. At present, what we need is the total equity capital. So total equity capital is basically my here. So what we have understood return on equity, right? So return on equity, what we have understood that I have to go to my net profit, right? Divided by
Total equity capital.
equity capital we have already calculated. So that comes out to be how much? That comes out to be approximately 18%. Right? So once I have the ROE, then the question will automatically come, where from this I am generating my ROE, that we have discussed in this part, right? So if I want to know my PAT margin, so my PAT margin is basically already we have calculated, but for another round, let's do it. So this is my PAT divided by our
revenue.
Is approximately 16.94 that we have. How that financial multiplier will tell me how that asset has been funded, right? So how that asset has been funded? So my financial multiplier is
Total assets divided by capital equity.
Total capital. So total assets figure we have, total equity we have, right? Now, if I want to know my ROE, right? This is what we have discussed in before going for the break, that I could dismantle my ROE and then I can see that how that ROE has been generated and which one is the source which has been contributed maximum to the generation of that ROE, right? Whether it is my profit margin, whether it is my sales efficiency, or whether it is my what? You can say my financing choices that my company is having in terms of taking care of. So this is your financial. Understood. I'm going to the annual report again, please. So what we have understood that the liability side will indicate that how much the company is loaded with the debt. So if you see this company and the long-term liabilities, what you have? Only you have one thing, that is what? Lease liabilities. There is no borrowings, nothing. Okay. They have also some lease liability in the current category also. But as I told you, if financial lease is there, that is an alternative mode of getting the funding as compared to the debt. So only one thing that is available to me to some extent is the financial lease. Apart from that, you see there is no borrowings. But if a company will have debt, then the debt will be definitely visible here as a heading of what? Debt. So since debt is not there, we will take the financial lease liability as one variable of my what? Borrowing category. But it is not a direct borrowing. Are you getting my point?
Yeah.
Now, if I again take you back to our calculations that we are trying to do. So once I have ROE, so it is giving me approximately how much? 23%. Then I will have my what? ROA. And ROA, as you know, we could think of from two perspectives. One is basically from the EBIT perspective. In this case, majority of your assets have been funded by what?
Banks, loans.
Equity capital.
Equity. Banks and loans are very few, right? So my total assets in this case will be my EBIT divided by my what? Total assets.
Assets.
If I want to look at the PAT is more appropriate in this case. Why? Because in this case, my company is majorly funded by what?
Equity capital.
Equity.
In this case, this is the few things that we could see, that how much is my return on asset, invested capital if I have, and the ROE that I will have. Another thing that comes in the discussions the tax implications, then sometimes in the normal course of discussions, you heard something called as NOPAT. Have you heard of it? NOPAT. NOPAT is what? It is called as your
No profit of
Net operating profit after tax.
net operating profit after tax. So net operating profit after tax means what? You have your EBIT with you, isn't it? So EBIT is with you, multiplied with your tax rate. So multiplied with 1 minus tax, right? So let's assume the tax rate is 30%. Then my NOPAT is how much? Approximately this much. But in some cases, NOPAT is in the discussion, so I thought that you should know about it. So that will be basically my NOPAT. But here we are assuming tax. How much we are assuming? 30% we are assuming as tax. Okay. Here now this ROE part and ROIC part and so on and so on, right?
So can you just the formula for that again? NOPAT?
which will tell me that whether the company operations are viable in terms of what? ROA, ROIC, ROE, right? And we have also discussed, apart from the written, we have early morning, we have also discussed as what? Margin metrics. Margin metrics are basically your what? PAT margin. Then you have EBIT margin. Then you have margin. Then you have what?
Gross profit.
Gross margin. These are basically your what? Margin metrics. Clear now?
Yes, sir.
This information will be available to me in the income statement. Clear? Then what I will do, I will calculate per day operating expenses. That means X by 365, right? So let's say X by 365 is Y. Okay. This information I am getting from where? From the income statement. I will also have something for my, in the balance sheet, I will have something more information. What is that? So let's say this is my cash and bank, or sometimes it is called as what? Cash and equivalents. Equivalence means what? Very near to cash. Okay, that means savings accounts which can be easily liquidated and get the money, that will be called as your cash and cash equivalents. You will also have some money in your bank. These two are basically what for your company?
Current asset.
Current asset.
Let's say your cash and bank or cash and cash equivalents, CB, and your bank, BL. Okay, I can calculate this total figure for every year. Let's say that figure is coming out to be CBL, let's assume. Okay. Now, what I will do, I will take CBN divided by Y. What it will tell me?
Yeah. How many days I can survive with the current asset?
Not current asset. How many days I can survive with cash?
Cash.
Or
Cash.
cash. So survival days your what? Cash run rate. So cash run rate will indicate me what? That let's say business gets stopped. I'm not getting any sales happening. Nothing is happening. But there will be some operating cost which will be keep on happening. Are you getting my point? So with the available cash, how many days I can run the soap? That is basically my what? Cash run. Clear now? Any questions?
So one question. I don't know. I always thought it is actually you take revenue and then divide the cost, multiply like into number of days, you get that operating expense, how many days we can survive. But we have to include revenue, right? Whenever we see how much is the revenue we are getting, how much we have to calculate cash run rate.
I just told you that let's say that there is no revenue stream is coming up. So that means my OPEX is purely dependent on my what? Cash, that is
Cash, whatever we have, yes.
Because whenever you are factoring revenue, then the question will automatically come that how you are factoring that revenue. So whatever the revenue is today, can you guarantee the same revenue tomorrow? Definitely not. Second thing is that as a company which is into operation, you will always expect the revenue to grow up. Now, revenue to grow, how much to grow? That will be some kind of approximation needs to be put into. So that is why we not considering the revenue. We are simply focusing that with the available cash, how many days I can sustain my revenue.
Got it, sir. Got it. Clear.
And one more challenge will come going by your logic is that my revenue in the top line is a mix of X plus Y. That means part of it is cash and part of it is accruals. So the whatever the revenue,
Cash and second one is?
accruals, your receivables. Is not cash.
Clear, sir. Clear. Got it. Yes.
Next point. Next point is basically my cash ratio. What is my cash ratio? That my company will be not only having operating expenses to deal with, my company will also have very current immediate liabilities that needs to be met. It may be your payables, it may be your bank overdraft, it may be very short-term liabilities which can be due at immediate point in time. So I should be able to understand that, let's say I will not rely on any other assets. I will only rely on my cash and cash equivalents and my bank. Then how much I can rely on my cash ratio. So basically your cash ratio is basically what? Your cash and cash equivalents divided by my current
liabilities.
Okay. Now there is no theoretical benchmark that how much it's supposed to be. It is always in the context of the industry that we are working. So basically, my point is that if you are into some kind of service sector company, your cash ratio might look very attractive. But if you are into a hardcore manufacturing and all, cash ratio may not look that attractive because the money takes a lot of time to come to you because of the longer process that you have in your business operations. Second thing is that if I start relying not on cash, but most of our current assets, then the metric that I have is called as my current ratio, which is nothing but simple comparison between your current assets and your current
Abilities.
What are the illiquid things I might have? And there comes your inventory. Or if you have some prepaid expenses also, because you have already paid that money is not available with you at any point in time. But if prepaid expenses is not available, what is theoretically more thing to deduct is basically your what? Inventory. So current assets minus inventory divided by your current
Liabilities.
Liabilities.
Current liability. So these are some of the metrics which will help me to make a better approximation of the liquidity position of my company. So my cash run rate, my cash ratio, my current ratio, and of course your quick ratio. Now, in this context, another thing that has been might have been in discussion for you is basically called as your what? Working capital. Working capital. Actually, working capital means is current asset. But whenever you use the word working capital, it is always called as the spread between current assets and current liabilities. So it is basically called as net working capital. But in typical discussion, we don't use that jargon called as how much is my current assets.
$1.5.
1,50,000. So that means if my current assets are 1,50,000, then my current liabilities will be of how much?
50,000.
50,000. Then only my working capital can be
CA minus CA.
Please don't. Okay.
This is one situation. Another situation, let's take it. My current ratio is, let's say, 0.83. Okay? 0.83. 83. My current asset, take the same example. How much? 1,50,000.
50,000.
Negative.
Minus
Negative.
minus 30,000. 3072.
So what is the logic we can build out of it? The moment my current ratio is becoming less than 1, chances are that I will have a negative working capital. Are you getting my point or not? So a company having a current assets, current ratio less than 1, that means indicates that working capital will be negative. That means current liabilities will be higher than current assets. But it may not be a wrong sign. It sounds wrong that my working capital is negative, but that does not necessarily mean that company liquidity position is bad. It's supposed to be always, as I mentioned, vis-a-vis to the industry. In that industry, it might be a common trend that the working capital is negative. For example, if you will take telecom industry, if you take airlines industry, they don't need much of the current assets because they don't need inventories to go forward, right? Most of the payments are basically prepayments. So there is very less chance that you will have a receivables to pile up. Are you getting my point? So in those business might be the not necessarily. In fact, if your working capital position is low, the cash flow to the company might be better. Okay, we will discuss that because we have one half is dedicated for the cash flow discussion. So again, we will come back to this particular point. Okay, please note it down somewhere. Your thoughts on working capital. Okay, please note it down somewhere that what you currently think the implications of working capital on the cash flow situation of the company, right? And the readings that Dr. Mahesh has shared with you, there is a reading called as when there is cash in your cash flow, right? So also please go through it because in the next session it will be helpful. So that you can understand it in a much better way in the next session. Okay. But at present, we'll keep the question on hold. Next. So once we will discuss these things. What is that? Current assets, current liabilities, and so on and so forth. One more thing comes to my mind is basically that let's assume you have a sales. Okay. Sales means revenue, right? Somebody was getting confused. So let's say sales or your revenue. Now,
Working capital.
Capital. So here also it is working capital turnover. How many of you have presented the budget to your corporate teams and your working capital requirements have not been sanctioned? Is there anyone? So how much is my working capital turnover in this particular case?
2. And this 4.
What it tells you now? What will be its interpretation? In order to generate a revenue of how much? 100,000. How much working capital dependency I have? That is what it is. So among the two, which one you will say is a good thing?
4.
4-1. 4.
With lesser dependency on your working capital, you could generate a higher
Sales.
Now, whenever you are presenting the budget, your company at the aggregate level, there must be a working capital turnover. Yes or no? Which I can deduce from the balance sheet. Let's say you are handling a division, and for that division, you are presenting the budget. That in the budget, you have to include your working capital provisions as well, right? But what if the working capital turnover of your division is lesser than the company? Very unlikely that the company is going to sanction the working capital budget. Simple reason is that whatever the company could generate the revenue with the
Clear.
Now, all the discussions that we had so far, what is that? Current assets, current liabilities, working capital, right? Now, a company, let's say you are saying that I don't need any working capital, zero working capital. When you can do that, when you have immediate money is available to you and you don't need any provision for the working capital to proceed further. Are you getting my point? But if I typically break down a company operations, what will be the 3 important things that will come up?
Cash.
The operating.
Cash will be the one.
One will be cash. Then
Inventory. Inventory.
your inventory, okay.
Receivables.
Receivables, which is part of my sales.
Sales.
Yes.
What else?
Operating expense.
operating
Expense.
expenses, and also
Cost of goods sold.
cost of goods sold will take care of your what?
Sales.
Payable.
Sales. Revenue.
It will take care of your operating expenses, you see. Either you might have payables due, or you might have purchased for which you have payables, right? So one part will be, of course, the payment side. One part will be my receipt side, and one part will be my inventory that I am handling, right? Whole story can be summarized on this. Now, there are two sources on which you are getting money. One source is
Sales should be increased.
Sales on inventory less.
Sales receivables to go down, inventory to go down, and payable to go up.
Payables to go up.
inventory
Inventory to go down, and payable to go up.
That means what? I will be collecting the money quickly.
Faster, selling faster and paying later.
Inventories I should be clearing quickly. Then only I will get money quickly. If I get money quickly and pay money at a later date, then it will have a positive effect on my cash position. Everybody clear with this example?
Yes.
So what this metric that you are saying, that you are collecting the money quickly. So that is name is called as your what? Account receivable turnover.
Is it also called DSO?
Days will come back. So this is basically your inventory what?
Turnover.
And this is your accounts payable turnover. That means what? How many times in a year you are turning around your receivables? So let's say I will tell you that I am turning around my receivable 4 times in a year. The moment I will say 4 times in a year, how many days credit?
3 months.
90 days.
120 days. Divided by 4. So that is what you are saying days. So days will only come when I will have the turnover things with me. So the turnover, if I see that 365 divided by turnover is giving me the days, you will always expect a lesser day. Collecting, you will sometimes the inventory is not getting cleared the way it's supposed to get cleared, right? So that fluctuations might happen over the 2 years. So taking an average nullifies those effects. So ideally, it's supposed to take receivables, but if the data is available with you for 2 years, it is advisable to go for an average. If the data is only available for you for 1 year only, then there is no choice. You have to take what? Only that years. So in that case, your answer will be receivable only. If data is available, I will take the average data. Is it okay, clear?
Yes.
Similarly, the moment I will say inventory, inventory is related to what?
Cost of goods sold.
Cost of goods sold divided by
Average inventory.
average inventory. Payables are related to what?
Purchases.
Purchase. So it will give you what? Turnovers, correct? Once you have the turnovers with you, then you have what? Days of accounts receivable, days of inventory, days of, which is nothing but what? 365 divided by account receivable turnover. Receivable days plus inventory days minus what? Payment. Because two sources I'm getting money. In one source I'm paying money. So that will give me my what? Gas conversion cycle. So gas conversion cycle is better if your average inventories are average receivables are low, average inventories are low, because it will automatically give you better turnover. If it is better turnover, you have lesser days. Clear now?
Yes, sir.
In the payable part, what will happen? I need a payable days. More or less. More. To have the payable more, I need a payable turnover less. Payable turnover can be less if your payables will be
More.
right. That is the logic. So now, as per this mathematical formula, can your CCC be negative? Can your CCC be negative?
Yes, it can be.
Yes, it can be, sir.
I think yes.
Right? If it Yeah, if payable will go up, turnover will go down.
Okay.
Turnover will go down, days will go up.
Okay.
If days will go up, I might end up in a negative cash conversion cycle. So negative cash conversion cycle only happen when you are paying at a very later date, but you are collecting and selling at a very faster date.
Okay. Clear.
Right. So if product shelf life is very low, then your bargain power automatically shifts. But if your product is very slow moving in the market, shelf life is very high, then automatically you have to put more things on display to sell. And in that case, you can't bargain to get the money quickly. You getting my point? Similarly, if your products having a better branding in the market, brand dominance is there, and hence you have a larger market share, then also it shifts the power to the seller that I will collect the money very fast. And because you have a demand side effect, you might have an economies of scale. And because of that economies of scale, no vendor wants to leave you. Are you getting my point? If no vendor wants to leave you, if vendor wants to stick with you, again power shifts to your hand to negotiate for a longer payment cycle. In either of the case, you will always having a what? A negative cash conversion cycle. Now, one question, Jana Samaji. So, you are a company where you note down the themes. You are a company having a cash conversion cycle of 120 days. Positive 120 days. Okay, that is scenario 1. Scenario 2 is you are a company where cash conversion cycle is minus 52. Note down these things. Scenario 1, CCC positive, how many days? 120 days.
20 days.
Scenario 2, CCC minus 52 days. Okay. Second fact, my cash run rate is 80 days. Cash run rate is
80 days.
Both the cases same. This company also cash run rate 80 days. The other company also cash run rate 80 days. What it tells you? Jina Swamiji.
But I'm minus 52 days is the better one. No?
Of course, you see, you don't have to worry for your vendor payments till 52 days. Till 83 days, or how many days I said, cash run rate?
80.
Available money can run your show till 80 days. Even after that, okay, you have to worry about your vendor payments and all because your CCC is negative. But on the other hand, you have available cash only to run the show till 80 days. And you have to wait to get money till 120 days.
80 days.
So you are going to fall short of cash for 40 days approximately.
Correct. Correct.
Maybe some overdraft facility or borrowings or some liquidity crunch is going to be there. So CCC, if it is positive, lesser it is, better it is, because faster I am getting money. If it is negative, the more the bigger it is, better it is.
Okay, clear, sir. Clear.
When you link the dots, the picture will be better.
Okay.
Everybody comfortable, right?
Okay, sir, these values are available in which statement, cash flow or the balance sheet, where we will find this cash conversion cycle?
You have to calculate.
In a broader perspective, which sheet we will get this information?
I will do only, sir. It's my job.
And that's basically on your receivables. When you collect the cash on a receivable, say like within 60 days or 30 days, your CCC is improved.
Sooner it is, better it is. But yeah, it is depends also on the business. If it is service sector, you might be collecting money very fast. But if you have a long supply chain, not necessary that you will be able to collect the money so fast, right?
Correct.
Example, like if you see like McDonald's or KFC, they collect it in advance. Yeah, so that's
yeah,
negative.
so they are money on other people's money.
Yes.
They are basically making money on what? Other people's money. So now, can you see the Excel?
Not yet, sir.
So let me go to balance it first. So here, majority of the things that we have discussed, you will find them we are talking from either from the current asset perspective, or we are talking it from the current liability perspective, right? So in the current asset perspective, do you have inventories here? Yes. Total current assets here, right? Receivables here, right? Cash equivalents, okay. Bank here, right? Similarly, your accounts payable, is it here?
Sir, one question.
Yeah.
So what is the bank balance other than cash equivalents? I mean, it's the cash other, I mean, bank,
we'll pay attention to it. So we have 12 and 13, okay, as the notes. Can you see that?
Yeah.
Can you see that? Cash and cash equivalents are cash, balances with bank, and short term, which is 3 months or less. Highly liquid investments that are readily convertible into cash and which are subject to an insignificant risk of change in value. What are the things available? Cash on hand. Nobody keeps nowadays cash on hand, at least for a company like HUL. Balances with bank in current account, in term deposit, treasury bills, overnight mutual funds. So if you see, we are saying cash, but it is actually a kind of bank only, right? Now, what is bank other than cash? Earmarked balances with banks, unpaid dividend, others, investments in term deposits with original maturity more than 3 months but less than 12 months. So out of this, you can say that this might be more liquid. Unpaid dividend I should not touch because it is anyway shareholders' money. That's why the name is what? Cash and cash equivalent, right? That means which is very close to cash. Okay, but it is word suggests cash, but it is actually bank. But it is so liquid that any moment I can get it as in my hand as cash. Clear now?
Yes, sir. Yeah. Got it. Thank you.
So I have shown you in the balance sheet all the parameters that we have majorly discussed in the previous 2 slides are easily available on the balance sheet side. Okay. So what I have done meanwhile, I have taken those figures to our calculation sheet, right? Where we are doing all the calculations. Now we are majorly interested on which aspect?
Liquidity matrix.
Liquidity matrix. Now that liquidity matrix, let's understand. So here you will see, I have taken the parameters. Can you see cash and cash equivalents? These 2 figures that you see here is for the previous year and for this year. I have taken it. But do you have cash and cash equivalents? Yes, we have, right? Now, what we will do, we will first compute my per day operating expenses. So my per day operating expenses is what? Per day operating expenses is I have not taken the inventory and other things because we are not considering sales. So we have not touched upon that. So per day operating expenses will be what? Total operating expenses divided by 360. Right. Once I have my per day operating expenses, can I have my cash run rate? So my cash run rate is what basically? Available cash
Divided by
my
per day of operating expense.
Per day operating expense.
No business till you can run the show just by the money that you are holding in your hand. By approximately how many days? 30 days. Okay. Now what we have
It is a thumb rule. It is a thumb rule, right? This 30 days cash flow.
Sorry.
The 30 days is a thumb rule or is maybe generically followed?
It is coming for the HUL, but for another company it might be different, right? Depending on that financials of that particular company, vis-a-vis the industry in which it is working. Okay. Now current ratio, we know how to get the current ratio for us. So current ratio is our current assets
upon current liability.
By current liabilities. 1.38. So if it is more than 1, chances are that working capital will not be negative, correct? Then what is my quick ratio?
Current assets minus inventory upon liabilities.
Yes, so current assets
minus inventory divided by current liability.
Quick ratio. What is my cash ratio?
Cash plus cash equivalents upon current liability.
So my cash and cash equivalents. This, do you want to add bank or not? It is purely
bank balance also.
But in this case of bank balance, the only thing is that it is partly contaminated with the unpaid dividend, right? Yes or no? When we see the annual report, we get an understanding that there is an unpaid dividend of how much?
269.
So let me take that figure, unpaid dividend 219. Then only I can do it in a genuine way. That my cash ratio is basically what? Cash ratio is my cash and cash equivalents plus my bank minus my dividend. This is I should not take actually. That's divided by my current liabilities. Okay, so that is basically your cash ratio. Whether these figures are good or not, I can only compare with respect to past trend and the peer group that we have, right? Now, how much is my working capital? Is basically what?
Current assets minus current liability.
This minus this. That's why I told you working capital will be not negative. Working capital turnover.
Revenue upon
By working capital.
My working capital turnover is basically revenue divided by
working capital.
Working capital.
okay. So what will be its interpretation? You are making 12 times the sales of the working capital dependency that you have. Are you getting my point? No? So that is basically your what? Working capital. Is it okay? Any doubts so far?
So similar way, you can copy the from the presentation. You can make some correlation so that it will be easy future reference possible.
Right? So your cash ratio is here. Your current ratio, your quick ratio, and what is that? Your working capital.
Working capital.
Your working capital is here. Right? Your working capital turnover is also here. All good? Done?
Done.
Next. Once you have the liquidity matrix, then you have what?
Efficiency matrix.
Efficiency matrix. In case of efficiency matrix, one thing you are already aware of is basically your what? Asset turnover. Asset turnover you are already aware of. What is that? Sales.
Or
Your total asset. That is basically your asset turnover. Along with, so asset turnover interpretation is what? 1 rupee invested in my asset. How much sales I am
Generating.
generated.
But we can also have account receivable turnover. We can also have what?
Account payable.
We can also have Right? You can also think about that how much is my capital turnover? Capital turnover. If I want to know capital turnover, then it is basically what? My sales divided by equity.
Total equity.
Capital. 1 rupee invested in your capital, how much sales you are able to provide. Now, for asset turnover and all, we need what? Average assets and all. So what we have done here, meanwhile, we have collected the data for all the 2 consecutive years with us, so that we'll be able to keep at pace with the logic of having the what? Average with us. Yes or no? So we have here right? 3 things. Average. We'll require it, right?
Yes.
Now, formula is already known to you. Where we have the formulas with us here. All the metrics that we will probably require. So my account receivable turnover is what? My revenue.
Revenue upon accounts receivable days.
Divided by F.
Average accounts receivables.
Average.
Correct. Now, pay attention to one thing. Ideally, I should take in the numerator the credit sales, because the denominator I am taking what? My receivables. But unfortunately, no company reports how much is the credit sales. So we have to take only the total sales as part of my assumption is that all sales are credit. So that is it. So you have, oh sorry, you have done it, right? So that is your account receivable turnover. Then your inventory turnover is basically your COGS. Divided by your average inventory. Right? Then you have accounts payable turnover, which is related to your purchases. So some stock in trade we have purchased, and the raw material also you must have purchased. So that divided by average accounts payables. So account receivable turnover days is basically 365 divided by account receivable. Inventory turnover days is basically 365 divided by
Inventory turnover.
inventory turnover. Accounts payable days is basically 365 divided by
Payable turnover.
payables. Full turnover I have taken G4, G5. You only take G4. G4 is what? Purchase job, sorry, G5 you take. Because the figure is coming around to be unrealistic.
Actually, you inserted one row. That's what this changes.
Sorry.
Actually, you inserted. You copy. You inserted in the left hand side. One row.
No, accounts payable turnover. I have taken this and the average. Where I made mistake?
Sir, here I think
That's
that
what
is
you
9.
inserted one row, eight, serial number 8 row you inserted. Maybe that.
Okay.
You
Sir, I think the value, trade payables, it cannot be 90,000 and 8,000. There is some difference, huge difference.
Or maybe a 0. Yes.
Good to go and
That's what you copy some, you inserted one row in the serial number 8.
no, that
to
will not
calculate
No,
this average.
that is not an issue.
because this is, yeah, his point is correct.
Sir, it is 9,008. There it is 90,000.
Yeah, it is 9068, right?
9008.
9008.
But when it will be added, it will be this also and this also. Micro and
9068.
But
and
in that
small.
case,
9068.
yeah, there is 1 0 extra there.
Because the figure was looking unrealistic. Yeah, now it is. So my cash conversion cycle is what? Account receivable plus inventory minus
Yes, turnover days.
On paper.
minus 58. Very good, is not it? Before COVID, it was more than 100. After COVID, things have been slightly turned, but not very drastically changed. But still, they enjoy what?
People's money.
Negative CCC. So everything that you want to refer after the class, everything is here. The only thing is that you have to pay some extra time. Clear now?
So one
What
doubt.
is CRR in this case? CRR. in this case?
Go on.
This CRR is how much in this case?
CRR.
Cash
Cash,
run rate.
Achha, cash run rate. Cash run rate is 30 days.
30 days, okay.
So you can easily sustain your business 30 days in any way, and 50 days you don't have to pay to anyone. 58 days.
Okay.
Okay? Yeah. Next point. We'll go to the theory board first. Then we will come back.
So just one point over here, that say they will be procuring items from some vendors, HUL. So, and they also give, say, some advance bank guarantees, 20% of the amount. So where that they will be considering that as a cash or what?
Your bank guarantee, right?
Yes.
So that bank guarantee.
So that should be a part of operating cost, right?
No, but vendor gives it to me and saying that this is advance, and it
So bank guarantee is with bank. It doesn't goes to the client. It stays with bank.
It is the instrument that you are providing, not the cash.
Okay, so we will not utilize that cash. We'll just keep it.
No,
It is sort of bond. It is sort of bond.
Bank is guaranteeing for us. We may have to pay only the charge for that after that particular period. So it will be coming as an operating expense.
Okay.
And that is utilized only in case of arbitration.
Yes.
The client has got the right to take that.
Right. Otherwise, it is just a kind of official bond or a note, not a real transfer of money. Right?
Just like letter of credit.
Yes, I got it. Thanks. Thank you, everyone.
Now, the debt, what you typically heard its name in the discussions. What it is otherwise called.
Loss.
What we owe.
Huh?
What we owe.
It's called as dividends. Right? So, any debt that you are having is called as your leverage. And this leverage is linked to your solvency, which is basically your long-term viability. So that means how much is my debt to my equity. So basically my debt divided by my what? Equity. Yeah. Correct? Huh? But if you pay attention to one thing, this metric that you have is only telling you whether you have 30% debt and 70% equity, kind of thing, right? So it is only saying you the proportion. But earlier, when you heard about this financial multiplier, this financial multiplier is what? Financial multiplier is your total assets divided by
Total capital.
equity capital. It is telling you how much proportion of the asset has been funded. So if this ratio is high, then definitely this ratio is going to be high. Because if you have more debt as compared to equity, then majority of your assets must have been funded by debt only. That means financial multiplier will be higher, right? But earlier, when just after the break, when Anandji was asking the question, that some of their friends who borrow, they are not worried. Why they are not worried? The debt, servicing that debt is basically your what?
Interest cost.
So whether I am able to coverage my interest or not, that I can only decide how. Right? Whether I have sufficient operating profit to serve my interest. So if these two ratios are high, then this ratio is going to be low. Because if you have more debt, then your interest coverage ratio is going to be very low. So if in HUL, I will tell you that the debt is almost like close to zero, then the interest coverage ratio is supposed to be more than what?
One.
It has to be more than one.
More than one. Greater than one.
We will see. But it will be a negative relationship, isn't it? That debt to equity ratio, if it is high, your interest coverage ratio will be automatically very low. And opposite will happen. So the moment you see a better interest coverage ratio means you know that debt to equity ratio will be low. If debt to equity ratio is low, then financial multiplier is supposed to be high. Yes, sorry, financial multiplier is supposed to
That has to be low.
Low. So financial multiplier is low. That means majority of your assets have been funded by
Your own capital.
your own capital, equity and your retained earnings part. Is it okay? So all the three metrics that we have is basically linking to which side of the story? Is linking to the solvency side of the story. So again, we will go back to our original screen chat. So my Excel file is visible?
Not yet, sir.
Okay, sir.
Not yet. Okay. So we are on the Excel. Now it is visible.
Yes, sir.
So what we have now, which metric we are talking about now?
Debt metrics, solvency metrics.
Solvency metric.
Correct. So first we understood what? Debt to
Equity.
Equity ratio.
debt to equity. So in this case,
Debt.
I have shown you the balance sheet. There was not much debt. The only thing that I have is what? Lease liabilities, which I am assuming as one of the sources of debt. So divided by my what? Equity capital. So as you see,
Equity
debt
capital.
equity is close to zero, right? Now, if debt equity ratio is there, then can I have my financial
Multiplier.
multiplier? So my financial
Total
multiplier.
asset. Total asset by equity capital.
Very good. Total assets divided by equity capital. And I can have my, since I have seen that debt equity ratio is zero, interest coverage ratio I can easily expect.
Has to be lower.
So interest coverage ratio is what? Your EBIT.
EBIT divided by interest.
That is basically your what? Finance cost. How much is the finance cost? 10. Right? Very high. It makes sense because my solvency metrics will be very what? But very positive sign because the debt equity. Right? Good. This is your debt equity. One interesting thing, if you will pay slight attention, is there any relationship between your growth opportunity and your leverage? Next class, we will pick up this issue that my debt coverage and my what? Debt coverage and my growth opportunity, what kind of relationship we can expect out of it.
Sir, one doubt, and the last solvency metrics. Suppose if you are going for loan or to increase our debt, the bankers will ask this ratio, this metrics, right? Whether the company, what they will ask.
Usually they look at the solvency metrics. If the solvency metrics is very high, sound solvency, then basically your credit rating will be also better.
So,
right?
Okay.
Your credit rating will be much better. Now, what we will do, we will go to one of the very popular website in the finance. Many of you might be aware of. You know it, right? Money control. So I'm on the money control website. So in the money control, I can press the link if you want to open it there. No issues. Why it is not? So in the money control, you can see that here is something called as financials. I'll go to financials. Here I have ratios, margin ratios, gross profit, operating profit, net profit. Are you clear? Return ratios, return on net worth or return on equity. You know that they both can be called return on capital, return on asset. Liquidity ratio, current ratio, quick ratio. You also know cash ratio, cash run rate, working capital, leverage ratio, debt to equity ratio, interest coverage ratio. And you see, they have taken the data as 0, so interest coverage ratio is much better. Turnover ratio, asset turnover ratio, inventory turnover ratio. Growth ratio, this is basically your CAGR sales growth. Valuation ratio, we have only discussed what? Price to book. These things we will cover up in the next class. Is it okay?
Yes, sir.
Now we will do one more thing. We will go to, so anyone can volunteer whose internet bandwidth is better. We'll go to Vishal. Vishal, so you have those readings that you called in the morning, right? Do you have that readings?
Yes, I've got that.
So just open the reading that is day 1 financial statement analysis. That must be one reading.
Yeah, it is there, sir. I even got a printout of that as well.
Okay, no. Soft copy, can you share?
Yes.
Do you have? So just give me a second. I'm making Vishal, how to make him a co-host.
Sir, you'll have to click on my picture. There will be 3 dots.
Yeah,
That will help you.
I can make it is not showing any option because I am co-host, so I can't make you co-host.
You need to ask Anisuma, Bhakti ma'am or something. Ask her.
Yeah, so they'll be able to do that.
It's done now. It's done.
It is okay.
They have already made you the host.
Okay, Vishal, now you are host.
Yes,
Can you share that reading?
Sure, sir. I'll share my screen. So this is it. I hope everyone is able to see.
Yeah, we can see.
Yes.
It is visible. No, this is there is another reading is there, same name.
These are the ones, sir. Financial analysis techniques.
Yes. So this reading is something that you should all come prepared in by the next class. So go down. I will quickly just touch upon. Go down. Exhibit. Go down. So this is what all theories are that you have to read. But you can easily understand it. Go down. Yeah, if the ratios are there, just go up. There is ratios mentioned, right? So these are the ratios that we have. So you can note down the page number. Later on, you can check quickly.
So this is page number 10.
Page number 10. So ratios, net income, revenue go down. All are having small numericals also for you. Okay, so we can easily practice. Operating income by average total assets. Operating income is what? EBIT. EBIT by assets. That is basically your what? Return on assets. Go down. Go down. There will be small exhibit. Go down.
Exhibit 3.
Exhibit 3. Go to exhibit 3. There will be a small table where the ratios have been mentioned.
It is exhibit 12, I believe. That is on page number 300.
No, 283.
Just go up, go up, go up, go up. You stop it. You see, we have discussed different aspects. Exhibit number 9, solvency, liquidity, profitability, efficiency is the activity. Clear now? So all these headings we have discussed. This reading has the detailed theory of it. Okay, go down. Go down, down. Another exhibit will be there. Now stop. Inventory turnover, days of inventory turnover, receivable turnover, days sales outstanding, payable turnover, working capital turnover. All these things have been covered. Go down. Stop. Fixed asset turnover, total asset turnover. All these things are there in the Excel in calculation. This is where the detailed theory is available. Is it okay? Go down. Go down, down. Next exhibit. With all small numericals so that you can easily understand it. Go down. Next exhibit, go. Stop, go up. It is what? Liquidity ratios. Liquidity, go down. Stop. Current ratio, quick ratio, cash conversion cycle. Everything is done. Right? Go down. All theory and calculation. Everything is there. Go down. Next exhibit, go down. Solvency. Yeah. Go down. Debt to asset ratio, debt to capital ratio, debt to equity ratio, financial leverage ratio. Financial leverage ratio is what? Total asset to total equity. We call it as what? Financial multiplier. You see the last one. Financial leverage ratio. We call it as what? Financial multiplier. Name is same, but logic is remains the name is different, but the logic remains the same. Go down. Stop. Go. Interest coverage ratio. Clear? Fixed charges ratio. So as I told you, if I will take lease payment supposed to be taken also. Just they have made the modification to that. Okay. Details you have to read once. Go down. Profitability ratio, stop. Gross profit margin, operating profit margin, pre-tax margin, net profit margin, done. Go down. Stop. Return on asset, return on capital, return on equity, done. Go down. Go down. Stop. Go up. Have you done this? Return on equity, breaking into parts, then trying to understand what is happening, because of what, which is changing, correct?
Correct.
Go down. Stop. Net income by revenue, revenue by total asset, average total asset by average shareholders equity, right? Go down. Stop. Net income by EBT, EBT by EBIT, EBIT by revenue. Have you done this?
Yes, we have done.
Right? Go down. Beautifully, they have given you a break chart to the entire logic that we have discussed, how smoothly you can again understand it with small numericals. So that's why they have given all the things, and we have also done this in the Excel also, right? बस रुक जा कितना पढ़ेंगे. Okay, so now it is your responsibility. We have a gap now. Videos will be available, reading is available, practice material that we have used in this class. Okay, the Excel file also, and your what? PPT also, because PPT I have already incorporated in Excel, but yeah, maybe for the reference, it is good to have it. Got it.
Professor Soumya, you will share the Excel file?
PPT has already gone. Excel, just give me a moment. Excel is also done. Clear with the concepts, clear with the discussion, exactly know where to refer now. The first reading that is shown to us, that reading you can easily understand, but that reading is not very exhaustive. This reading that I have shown you and explained to you, this reading is quite exhaustive with very small numericals, description, so that from a very basic itself you can build on your foundations. Okay, so my suggestion will be read the first reading that Vishal shown, very small one, 10 to 12 pages. Then read this one till the point today we have shown. Some additional part is there which I will cover up in the next class. Is it okay? And next class we will go to the cash flow, better to understand the cash flow side of the business. Is it okay?
Okay, okay.
Yes, sir.
Okay. Yes, Professor Soumya.
So, Kabir.
Yes, sir.
Can I say hi to your daughter?
Sorry, sir.
Can I say hi to the daughter? I think
Oh,
daughter is.
I'll call her. Adia.
So we have the special guest at the last moment.
Hi.
Hi.
Say hi.
Hello. Hi.
How are you? Sir.
I'm good. I'm good. How are you?
I'm fine.
You're fine. God bless you.
Thank you, sir. Bye-bye.
Bye.
Bye.
I kept the door locked, but still she came in.
Oh, that's good. Actually, we realize my son is also very small for 8 years, so I understand. He must be waiting for me to go back to home. But it is good. It is. And please go through the readings. Any doubt?
Okay, sir.
Feel free to raise the questions in the next class. We will definitely answer.
Sure, sir.
Sure,
sir.
Thank you so much, sir.
Okay. Okay, Professor.
Thank you so much.
Thank you very much. Thank you.
Thank you very much.
Thank
Okay,
you,
guys.
thank you.
Thank you.
Bye.